So the investment process for the tax-exempt income fund has a couple components. One is top-down and the other is bottom-up. Top-down, we as a group have a view on interest rates, whether we think they're going to go up or going to go down. And that view depends on what the economy is doing, what our outlook is on inflation, the Federal Reserve. The top-down view also depends in part on how much supply we think there'll be in the municipal bond market, how much demand. So depending on our top-down view, we move the duration or interest rate sensitivity of the fund higher or lower. Now, the bottom-up part of our investment process is how we select specific securities. And we do that through credit analysis of the yield curve, sector underweights and overweights, and we go through a process where we select a specific security to buy and put in our portfolio, or alternatively come to a decision to sell a security in our portfolio. So two parts to the investment process, bottom up and top down. We generate income in the tax-exempt income fund in a couple ways. First of all, we generally buy long-term bonds, which have higher yields than shorter-term bonds. Second, we tend to hold very little cash in the fund because cash doesn't yield much. And the other thing we do that other funds don't necessarily do is if we bought a bond several years ago at a very high yield, and now it's a relatively short maturity bond, we won't sell that bond because it's short maturity. We'll hold on to it because we bought it at a very high yield. So that differentiates us a little bit compared to other funds and really helps us maintain a high yield. There's several ways we can protect a portfolio from rising interest rates. The first would be to hold additional cash. The second would be to use futures to hedge interest rate exposure. A third would be to reduce the average maturity of the holdings that we have. To mitigate risk in the portfolios now, we do have short durations versus comparable funds. We've shortened the average maturity of our portfolios so that if interest rates go up, which we expect will happen, the value of the bonds won't go down as much as they might otherwise.